What's going on, everybody? Brian O'Neill with eXp Realty here in the upstate of South Carolina, and I am with my longtime friend, Jon Adams with the Palmetto Mortgage Group here in Greenville, and we just want to do a video to talk about what's kind of going on with the interest rates, the mortgage industry. There's been some changing standards to the government loans, the FHA, USDA, and VA as far as credit scores and some other things. And Jon and we'll touch on that a little bit later on. But just to give you a little background on myself, I've been a real estate agent for 6 years now. I've been with eXp for 3. And just Jon and I have been talking about the rates here lately and what's going on in the market. And we felt it was good to do a quick video. It won't be, real quick, but a video explaining what mortgages are out there, what loans are out there for the consumer right now, and kind of seeing what else is going on with the rates and everything like that. So I'll let Jon introduce himself and give a little background into how long he's been in the business, and then we'll dive into the content.
Appreciate it, Brian. I think anytime we can, get on a call like this and put out some information to, our local community is always important. Not everybody's state and things like that are regulated a little bit different. So it gives us an opportunity to kind of figure out what's going on in our local market, which is the most important market. That's the one that we work in, and obviously the one where most of our clients are purchasing homes. But been a branch manager here at the Palmetto Mortgage Group, one of the managing partners for about coming up on 3.5 years now with the Palmetto Mortgage Group. Been in the business for a total of 16 years now. So saying that now, being in the business that long, I feel like my child just turned 15 or 16, and I'm like, wait a second, they were just born, can't be that long. So I feel like I'm becoming a dinosaur now. I've made it this long and went through the Great Recession and, made it out of that. And which I think a lot of people maybe feel like this is maybe kind of headed that way, but I don't think that we're at that level. That was really more of a collapse of both the mortgage market and the real estate, combined with inflated house prices, and then just banks going out of business by just writing toxic assets and not really caring what they were selling to Wall Street at the time. So, but yeah, been doing this a long time, and just feel like we can simplify, some things on this call that can maybe help the client. I think the biggest thing right now that I think we want to accomplish is, I know you have a plan and I have a plan respectfully on how we want clients to, the direction that we want to move them to. And one is safety first. Absolutely. We're putting in plans in place just like everybody to be safe at this moment and not, catch this virus. I think the second thing is it's consumer first. And I think, from a local market, I'm seeing a lot of real estate agents and lenders coming together to, put the consumer first. And they're the ones who are buying the house. They're the ones who are going to be making the payment. And, we obviously have a fiduciary responsibility to make sure that we're putting them in a good position at this moment, so there's no fallout, down the road that could hurt our market.
Absolutely. Absolutely. So with that being said, let's just hit on the basics as far as what is at the consumer's fingertips as far as loans. And we got the basic, the conventional, the FHA, USDA, and VA options. But let's just start with conventional right now. What are the basic guidelines or the to be able to qualify for conventional? Has anything changed since the whole craziness that's been going on?
No, conventional is still going really strong. I would probably say right now that is probably one of the better, loans that we could look at for any client at this time. If you've got 5% down, we probably just need to look at going conventional. Now it's really when those credit scores kind of start getting below that 660, 640. There's still a lot of lenders out there that can go down to 580, and obviously they're being able to do that is a plus for clients that were kind of in those lower tilt credit scores.
Mhm.
I know that particularly with our investors that we use, that's, those clients have kind of been pushed aside a little bit, honestly, just due because, right now there's more risk involved with individuals putting down less money around that 3 to 3.5%. So there's a little bit more risk there of maybe somebody going into foreclosure, but accompany that with the current market right now with the virus, people are losing their jobs. So that client has more of an opportunity, I would say, to maybe go into forbearance or foreclosure or something like that.
Mhm.
So some of these investors that service the loan, when I say investors, I'm kind of like bank investors that service the loan, are kind of steering away from that credit score just because the risk is a little bit higher and they don't really know where that client's going to end up in 2 to 3 years. So they're basically, what the banks do at that point is they price themselves out of the market. But there's still other banks that are like direct lenders. I'm a correspondent lender, but there's direct lenders out there that service their own loans and have no problem putting their money out there and holding on to that asset to maybe sell it down the road. So there's definitely a lot of options. I would say that pricing with FHA and as far as rates and stuff like that might be a little higher than they've normally been. But there's still people out there doing them. And, I just talk to a local, lender, talk to somebody that's doing that and kind of get their thoughts. I think that's the best thing you can do at this time is there's so much changes going on. I think we've talked about this before, where we quote somebody a rate one day, and this was maybe a couple of weeks ago, and literally within, by the end of the day, the rate was a half a point higher. Right. And, I've never seen anything like that in 15 years where rates changed that much in a 24-hour period. And in some instances, it got up to within 2 to 3 days, almost a full point from where we were pre-improving people. And, the market has stabilized since then a little bit. We're just still waiting for some of this to kind of pass by and slowly get back to normal.
You said about 30 seconds ago that you're a correspondence lender compared to a direct lender. Can you just touch on that real quick?
Yeah, so a correspondent lender is, we have, I would probably say 25, 30 different investors or bankers that we can price loans out with. And each one's going to have different pricing as far as their rates. And gives us an opportunity to, find the best rate and lock it with that person. And then basically we just sell it to that bank. So they'll end up servicing the loan. We as a correspondent lender do not service our own loans. So like if I locked somebody with PennyMac, which is a big time servicer, more than likely that loan would end up with PennyMac, and that would be the person who would be collecting their payments once the loan gets established.
Gotcha. Okay. And so going back to conventional, now it's still staying at the bare minimum credit score of 680, correct? There's been no real adjustment with that. So if you're at 680 and above, you got good DTI, got down payment options, that's basically going to be the most likely option that you're going to push for.
Yeah, I would say so. I mean, conventional can go down to 620, but I have seen a little bit more, when we run loans and pre-approve somebody, there's a system that Fannie Mae has called Automated Underwriting System. And we call it AUS in our kind of lender lingo term. And we run that through the app. We put the application, run it through the system, and it kind of spits out an approval or a denial based off the information that client has. Okay. So that approval is what we base our pre-approval off of. So it says, hey, if you can get all these conditions and these documents, then this loan should be approved and you should be able to close it. Okay. So what we're seeing right now is, I've had several that have, that 660 credit score or so. And if the DTI is starting to get a little bit high, I am starting to see more refers come back, which is not a denial. It's just pretty much that it's not really eligible at this moment. And which, they're tightening up on their guidelines a little bit, I think, just with different clients. And there's so many variables that go into it. I can't really speak on specifics because every client is different. But I would say 680 and above, there's definitely some good options that we can look at. We even have the ability to broker some loans out to some other investors, and where we kind of lose control of that process a little bit. It's not underwritten in the house, so it's another bank using their underwriters and things like that, which are really helping us at this moment with the lower kind of credit scores between that 600 to 660.
Right.
Client that still can get a good rate and still move forward with FHA and USDA or VA.
And I know you had sent me a text, I believe it was about midway through last week, talking about Ginnie Mae as far as FHA, USDA, and VA. I know it's kind of a blanket statement there, but it was something to the effect of, we could get approvals for people with credit scores as low as 660, but now they're kind of bumping that up. Can you go into a little bit further detail with that?
Yeah, so basically what happened a little over a week ago, a lot of these investors, when I was talking about the risk factor on some of the people putting down less money for down payment, and then obviously with the current economy, some people might be losing their jobs, things shutting down. These investors just kind of, in a short term, they didn't want to do the loans. I mean, there's a whole way I can kind of go in and kind of say why they stopped doing that. But in the short term for time, they just didn't really want to do them. So they priced themselves out of competition. And there was a big reaction to, like, one lender did it, another lender, and it was just kind of a domino effect that happened. And just like with anything, fear and panic can cause a lot of things. So you saw a lot of lenders within a 24-hour period on government loans just raise their credit score limits up to like 640, 660. But by the time Monday came around, that was on a Thursday, but by the time Monday came around, we were back down to doing 600 scores. Okay. So we went from like a 660 to a 640 by Friday, and then a 600, and it was kind of, there was just a big reaction. Now, some lenders didn't even see any changes. Sure. They stayed where they were at. Okay. And I think that was mainly a lot of direct lenders out there that just, like I said, a direct lender is somebody who's going to, sell directly to Fannie Mae, and most of them kind of service a good portion of their own loans. Okay.
Now, with that being said, are we back down? Now you were saying, are they still having to, like, to get a decent rate, or what are the rates right now as far as today or as of Friday?
I mean, actually, the market, I think, with conventional is really strong. I was, obviously, saying rates and stuff like that, we have to be real careful just with compliance issues and stuff like that. But sure. Definitely seeing things now back in the low threes. Okay. Low to mid threes, depending on, credit scores and loan to value and stuff like that. So I think, it's a great time to purchase. I still think it's a great time to potentially look at doing a refinance again. Mm-hmm. If you missed out, a month ago on getting everything locked, I mean, I think they're back down again to where it might make sense for a lot of people to still look at those. The biggest question is just, the safety of the client, and maybe you can speak a little bit more on, showing houses and what you're seeing out there. With getting clients that want to actually buy a house, and the things that you're facing.
Yeah, there's some buyers are holding back to see kind of what happens over the next month or so. Obviously, everything is still shut down through the end of April. But you do still have serious buyers out there, buyers that are very well qualified, and they're looking to purchase, and you still have sellers that still want to sell. So I think what you're going to see now is, you're going to see very well qualified buyers in the market now looking to purchase. And that's good for sellers. But as far as showing houses and stuff like that, obviously we are keeping our distance. We're doing virtual showings also. I've got a couple out of state buyers that are looking. And so what I'm doing is I'm basically going out and just doing video walkthroughs. If I can FaceTime them while they're available, if they're available while I'm doing the showing, then we'll do that. Other than that, I'm pretty much recording it and going through now. If they are in-person showings, which, we still have to do that, we are taking the proper precautions with the social distancing. washing hands. If they want to wear gloves and a mask, then that's totally their call. But other than that, I mean, it's we're fortunate here in South Carolina where we're still an essential employee. I know there's some states and even counties across the country that have pretty much said that real estate is non-essential. But it's just one of those. It's a crazy time that we're in right now, and but as far as the listing side, nothing has changed as far as my marketing from the listing standpoint. We're still doing 3D walkthroughs. We're doing video walkthroughs, drones, photography, and everything like that. So it's very the stuff that we have in place right now is very in person to be able to walk through a home, but not be physically there. But I know one of the big topics too right now with the unemployment and everything like that is forbearance of the mortgage payment. Can you touch base on that just for a little bit and kind of talk about the forbearance option if that's what somebody has to do?
Yeah, there's that's a really hot topic right now, and the best thing that I can say is that you just need to speak with the mortgage servicer, whoever's servicing your loan.
Okay.
Every lender probably has, or servicer has maybe a different option that they might be offering. The biggest thing though is forbearance is not forgiveness, and I think that's the message that people need to hear. You're just not going to be able to stop making your payment. If you're able to make your payment, you need to make your payment. So, and those are the questions that servicers are going to ask. Before we hopped on this call, I think on Friday I went to PennyMac who services my loan, and I went online just to, and there was stuff in there in my account that said, "Are you being affected by this?" and different questions, and it was like, "Can you make your mortgage payment or not make your mortgage payment?" And I just wanted to see, kind of where it was going to lead me. And the moment I clicked yes, I can make my mortgage payment right now, it was like, "You're not eligible, period." It was like this big box just came up and said, "You're not eligible for anything, keep making your payment." But it's not forgiveness. A lot of these really look at the details. If you are affected and you truly are, you contact that servicer and figure out exactly what options that they are looking at, because a lot of the forbearance issues are, they might say, "I might give you 6 months." Well, if your payment was $1,000 a month and you go 6 months without making a payment, so that's $6,000. Well, at the end of that, a lot of these policies and stuff that we're seeing, they're making them like balloon payment that back.
Wow.
So like they got to pay that $6,000 plus the interest at the end of that term that they didn't make a payment on. And well, if you lost your job, how, and you got that relief and you haven't really been able to save any money, how are you going to make that, balloon payment? Now, that's not every lender. That's just some that I have seen.
Sure.
But again, that's not forgiveness. I would ask, if they had any options to, maybe defer that payment or tack it on at the end of the loan without there actually being late hit your credit report. Because, you go through that process, you miss, and they're like, okay, well, they might help out and say, well, if you can't make the full, $6,000 payment plus your current mortgage payment, on that 7th month, we'll break it out over 12 months or something like that. Well, how's that really helping if your payment's $1,000 and now you're adding another $500 to it and you haven't been able to save? I mean, if you can make your payment, continue to make it. I would much rather see somebody, that if that truly is and they can't do it, is contact their local servicer or their bank, see what options they have. And instead of going into foreclosure or something like that, is maybe see if they can get the house on the market and try to, maybe call their local realtor and see what options they might have to maybe get out of the house or sell it.
Yeah, I think that's the biggest thing too, is when you call your servicer is make sure that you understand the forbearance. Like you were just saying, if it's a balloon at the end, I would try to talk them into tacking it on at the end of the loan, kind of like you were saying, just extending it those 6
Yeah.
months past what it's already at. But get something,
Get
don't
it in writing.
get it in
Absolutely.
writing. Exactly.
Make them send it over in writing, and it's your loan. Obviously, the servicer is going to be the final say in whatever policy they put out and what they want to adhere to. But if you've never been late and you can prove, certain things like with your job that you did lose it, you're unemployed, this, that, and the other, I'm sure that you can maybe talk with somebody to see if there's some other options. I mean, it never hurts to ask in that situation before missing a payment. You know,
Yeah,
you got to make your mortgage payment.
yeah, absolutely. I mean, it's unfortunate what's going on. Obviously, it'll pass, and hopefully we'll recover quickly from it. But no, man, this has been great. I think it's been super educational for the general public, and even for people that are actually looking to buy and we're kind of questioning what was going on with the mortgage rates and the mortgage industry right now. So, you got anything else?
I mean, it's still, like I said, it's still a good time to buy. It's still a good time to look at refinancing if that's an option, to try to lower those payments before maybe something happens, with a job or anything like that. But again, consumer first, real estate agent second, and loan officers third. That's just kind of the plan that we're operating on, is figuring out a way to help these clients that might have been affected,
Sure.
and moving forward. And we understand our local community better than anybody, with us being in here and working it. So yeah, we're still available, even though a lot of us are working from home. Most of my staff that we have is working from home at this time, but we still don't mind meeting somebody and keeping the proper distances at the office if we need to. Calls like this are becoming extremely valuable, where we can talk to clients through Zoom and share, screenshots and stuff of their mortgage terms and stuff, to make sure they understand what they're truly getting into, which is important. But
yeah, that's kind of a little shift that we've done too, is for, listing presentations or buyer presentations and stuff like that. We are sending those documents to them just to look over, and then doing a Zoom call like this. And, instead of, trying, the last resort is trying to go out to the property and see these people. If we can do it over Zoom, and then we establish a relationship, then we can move forward from there.
Yeah.
So it's interesting times for sure.
It is. It's very interesting. I really feel like, with the way the economy's going, I think rates are going to stay low for maybe 2 or 3 years. I think we learned a lot from the Great Recession. The feds did, the government and what they needed to do. You're seeing them pumping in, billions of dollars into mortgage-backed securities, to try to put more liquidity back into the market. So I think they've kind of learned, what caused it. And I think that's why you probably saw a knee-jerk reaction with a lot of investors and servicers, quickly changing guidelines with individual companies to not put themselves in a position if they thought something was coming down. Because last time, it just crashed. Everything just stopped immediately. There was no plan. There was, just business as usual. So we all know that the subprime market and some of the non-QM, non-qualified mortgages that are not your typical, just conventional FHA, USDA type stuff, that market was rampant with just low credit scores, 100% financing, DTI 60%, whatever. It was kind of like the Wild Wild West, and then accompany that with inflated real estate prices. It was definitely going to implode. So I think that's what you saw, is a lot of these investors take a step back as they remembered what happened in 2008. Like, wait a second, let's go ahead and shift a little bit, which is not a bad thing. Try to protect ourselves from maybe having some toxic assets that we, might not be able to sell to Wall Street or into the mortgage-backed securities. And now that things have kind of stabilized a little bit, they're starting to kind of lessen back up the guidelines. And I feel like we have a good plan. I think rates are going to stay low for a couple of years. The feds are not stupid. They're not going to continue to raise rates in an economy like it is right now. And I really feel if things go well, and this virus is, kicked out in the next 2 or 3 months, and we're able to kind of go back to work, I really feel like the housing market in real estate could really get our economy, going back again. I think if we stay strong in our local communities and throughout the United States with doing good lending practices and putting people in good situations, I really think the housing markets, could really bring us out of this economy. So.
Yeah, I hope so. I hope it's on the decline right now. I know the quarantine stuff is it's challenging for sure. But if anybody wanted to get pre-approved and talk to you about their lending options, what's a good contact information for you?
My cell phone, 864-590-4221. So again, that's 864-590-4221. Just shoot me a text, give me a phone call, and I got plenty of time right now, obviously not really being in the office, but more than happy to talk with anybody and come up with a plan. I think that's the biggest thing that I feel like I've been trying my hardest to do is when somebody calls, just, not really just, oh, here's a pre-approval, and I hope lenders just don't do that in general, but really dig in. I think it's more important now that we kind of go back to the basics. You and I both played baseball in college, played together, and no matter what level you go to, the fundamentals and the basics always apply. And I think, being able to go back to, really looking at what this client needs are, how long they're looking to be in the house, what mortgage is actually going to benefit them for their specific financial situation right now. And so they might qualify for, 4 or 5 different mortgages, but let's narrow that down. Let's find a price point that they feel comfortable with, right. Not just, so you can go up to 250 or 300, what payment range do you want to stay in? And let's make sure that the house that you're buying is going to put you at that payment range or under. How much closing costs are you going to need? The communication with us as lenders to real estate right now, I think is 10 times more important. We talked about this not too long ago where, y'all were getting multiple offers on houses just right and left, maybe a month ago. I mean, it was just, you put a house on the market, especially anything at 200 or below, maybe 225 and below.
Absolutely.
I mean, it was going off the market within, 24, 48 hours, multiple offers. I think maybe a week and a half ago, we might have seen a shift from a seller's market to maybe shifting over into a buyer's market with a little bit more restrictions on some of these, FHA loans and government loans. They're buying that particular price point, I think, overall, and there's not going to be as many out there maybe shopping at this point. So we might see a little bit more shift, and that's just my personal opinion. You might have some other options or things that you've seen, but I think, with the way the pricing is on some of the government loans right now, a lot of investors and lenders are needing more closing costs. And so, us having that conversation last week, if you're going to make an offer and we have an FHA loan or something, we might need to maximize that closing cost to help this client. Again, it's about the consumer, getting them in this house if they want it, and being able to appropriately sell that and talk to your seller is when you go take that offer of why we need this, why you might lose a little bit more equity, but other than that, the house could be sitting for a while, and you might have to make a couple of more mortgage payments before selling, but you've got a bird in hand. We just might need to, get a little bit more of that equity. You can always look at raising the price, $1,000 or $2,000 to cover some of that. But for you and I know with some other relationships that we have as well, knowing that going into making an offer, it makes this process so much more smoother for that client, and making sure that the end result comes out to the way that we actually set it up from the beginning.
Yeah, absolutely. I mean, we want the best for our clients. We want to make the situation work with our offer and the numbers and everything like that. So I think it's definitely important. We're still a little early in this. I mean, we're 3 weeks into the quarantine. We've had, obviously in the last 2 weeks, we've had 6 million people file for unemployment. Mm-hmm. So we may be seeing a little shift, but I still think homes that are under that 200 mark that are marketed well, updated and stuff like that. There's still very prominent buyers out there. It's a little bit of a feeding frenzy, but we may see a shift here in the next month or so. It just depends on, what's going to happen after April 30th. If they're going to keep extending this quarantine into May, it's going to be interesting to see what happens.
I think, from what I remember back in 2008, when I was kind of going through that, there was, things did slow down. Mm-hmm. And I think we've all can admit that there's, a little bit of a slowdown maybe on the real estate side, just with people kind of not really sure if I want people coming into my house.
Sure.
I'm still going to buy, but, let's just wait till this is over with. So there's probably a little bit slow down there, but it did feel, a little bit different now as opposed to when everything just happened in 2008 and there was just just kind of a complete meltdown. And it's still, like I said, it was still a good time to buy. I think what you'll see now is maybe more individuals that maybe could afford that 225, 250. And that's what they were looking at. Just due to a little bit of uncertainty, they might just lower it down to maybe 175, 200, where their payment's a little bit more comfortable. And I'm having those conversations with, the what ifs. What if this does happen? And any of that could happen at any given point, obviously, with anybody's job, without the virus or with it. But there is more of a reality that it could come to fruition. And we obviously don't want to put somebody in a position that, is setting them up for failure from day one. I mean, I just do not think that's the right thing to do.
Right. Exactly. Well, awesome, man. This was fun. We need to do this more often.
I know, man.
All right, cool. Well, look, like I said, if anybody wants to talk to Jon about getting pre-approved, kind of seeing what they would get pre-approved at, their interest rate and everything like that, give him a call, 864-590-4221. And then obviously, if you're looking to buy or sell, I'm more than happy to talk to you via Zoom, virtually, and everything like that. My phone number is 864-497-7107. But man, this was fun. Like I said, let's do it more often, maybe once a week or something like that.
Yeah. The market's changing rapidly. It seems like every day there could be something new. And that's, I try not to post a lot of stuff out there as far as, every guideline that change and stuff like that. I'd much rather have these conversations one-on-one because, just like, last Thursday, there was a knee-jerk reaction in the whole market and everybody's, this is going, and nobody knew what was going on. And then by Monday, we were all back down to kind of where we were when we started off. Yeah. And, so you put something out there, post it, and then, 2 days later, it's not true anymore. Yeah. So there is a lot more of that going on, just the ebbs and flows of the market trying to correct itself. And, that's why I think it's important that, you talk with somebody locally that you can, maybe see face-to-face through a call like this that's been in the area and can kind of keep updated with the changes going on, as opposed to having somebody that you don't even know if they're taking your phone call from mama's basement, and trying to give you a mortgage rate, eating potato chips or something like that. You just don't know if it's an online kind of lender, who you're actually dealing with, and do they really know our area, properly.
Yeah, so. Absolutely, man.
Yep.
Brother, I appreciate the time. And, like I said, we'll get this out there. And anybody has any questions, feel free to reach out to both of us.
All right, man. Take it easy, man. Stay safe.
All right, brother. See you.
All right.